Market commentary of the day. And Brad, JPMorgan analyst Doug Anmuth is lowering Netflix's estimates to reflect recent comments from management around margin expansion and growth trajectory. He believes the streaming giant stock remains positive overall, but has concerns that paid sharing is less impactful than expected. And really interesting note here from the folks at JPMorgan, Brad. But you really have to start with the fact that Netflix shares down about 14% over the past 2 weeks. S&P 500 down about, let's say, 4.5%. There's concern going into this Netflix quarter that all the hype around all the changes, the password crackdown, the move to put ads on the platform, it may just be a big fat dud in terms of profits, whether that is operating profits or net profits.
Yeah, some of the key takeaways from this, as a result, their 2024 and 2025 estimates, they come down for revenue by about 2 to 3%, for operating income by about 5 to 6%. And as you're continuing to really evaluate what they're looking towards, and some of this had come forward during their trending report earlier this month, but particularly remaining overweight here, but lowering the December 2024 price target to $455 based on about 24.5 times the free cash flow for the end of 2025 of $8.1 billion. So all of this considered, I think as you're looking across the continued impact because of the crackdown on paid sharing through Q3, mobile usage, and certain other sharing instances, suggesting the company can continue to tighten up paid sharing going forward is what they're writing here. But advertising remains the crawl phase here.
I like that. It's pretty good.
Crawl
phase. But you go down to this bottom of this report, Brad, and certainly there's concern about the near-term outlook for company Netflix. But under the investment thesis section, we believe Netflix is a key beneficiary and driver of the ongoing disruption of linear TV. And I think that is an important longer-term consideration, not only Netflix, but of course names of like Roku, because look what we're seeing out of Disney, Brad. Here is a Disney under Bob Iger still they're flailing around, trying to figure out what to do with their TV assets. And he pulled the trigger on that ABC. He worked at ABC. He understands ABC, that is Bob Iger. So to see Bob Iger out there reportedly shopping those ABC assets, wow, it just tells you that the push to streaming remains not only alive and well, it continues to accelerate and drive a lot of disruption.
Well, one company or one platform that would certainly want for there to not be, at least, as we think about where Netflix has lagged in some of the live element or sports element, they've certainly leaned into some of the non-scripted television most recently. I mean, Love is Blind is back for what, a fifth season?
I never saw that.
We just saw the ads behind us in Times Square yesterday. And I didn't know that we were at season 5 of Love is Blind already. So I'm excited. But it's the trash TV that they've been able to bring on and get people like Brian Sozzi to stay on the platform.
He's going to call me out.
I won't tell them what show you watch. You can tell them that for yourself.
Please don't. I will just add this very quickly. I understand the near-term concern on Netflix, but that bidding between Comcast and Disney, and the FT really broke it down earlier in the week, that has begun for that Hulu asset. Some of the valuations being talked about potentially for Hulu are pretty mind-blowing. It's unclear ultimately how much Disney will pay for that asset, but something like that, if a big number does come through and Disney puts out a lot of money for Hulu, that could actually boost Netflix's stock.